and welcome again to my show, Searching for Integrity. My name really is John Smith. I'm searching for people with integrity. Why? Because our country suffers from IDD, Integrity Deficit Disorder. Today, you have me, myself, and I to cover a lot of little reports regarding the banking problems that we've been noticed and given information about. And a lot of people have a lot of different opinions on what's going to happen. Once upon a time, I was a CPA in a holding company that happened to own one of the savings and loans that didn't do well. And it was much the same in terms of how it happens and what it happens and what the steps are going to go from there. And I'll give you that as we get along. Get along, little doggy. Let's see. At that time, I was a CPA, and it was for the holding company. They savings and loan in the early 80s. I was an administration guy, and I had nothing to do with the loans, which was a good thing for me in the end. Yes, it did. If I begin with, as I said, some reports and information about what's been going on in the last week, 10 days. Sure has surprised everybody. And it sure is a lot of people pulling and moving their money out of the bank. Well, let me get started. Two conflicting narratives: Silicon Valley Bank contagion and a possible pivot from the Federal Reserve will determine the next major move for the stock market. In a dirty kitchen, whenever you see one cockroach, you can bet your boots that there are a lot more cockroaches to be found. Silicon Valley Bank has dominated the news recently, but two more banks, Signature Bank and Credit Suisse, also joined the mismanaged bank club. Credit Suisse disclosed massive losses because of horrible internal supervision that failed to adequately monitor its risk management policies. Credit Suisse disclosed massive losses because of horrible internal supervision that failed to adequately monitor its risk management policies. Credit Suisse disclosed this, and certainly sooner than later, the bank officially stated that the material weakness could result in misstatements of account balances or disclosures that would result in a material misstatement to the annual financial statements of Credit Suisse. Credit Suisse shares plunged to an all-time low on the news. The two common threads between all of the banking failures are incompetent management, and two, the bond wipeout caused by central banks' aggressive rate increases. The Fed has been on an inflation fighting crusade, raising interest rates and unprecedented 8 consecutive times, from near zero to 4.75% since 2021. That rapid increase caused the worst bear market for bonds in the history of the U.S. In 2022, the 30-year Treasury bond lost 39.2%. That's right, 39.2%. Nobody thought that could happen, but it has happened. That size of loss for bonds is unprecedented. In fact, you have to go all the way back to Napoleonic War in 1803, when long bonds lost 19% in a single year. If those bond losses that are behind the massive losses at Silicon Valley Bank, Signature Bank, and Credit Suisse, those three banks have lots of company. I have seen estimates of as much as 1 trillion in unrealized losses for American banks. Those roosters are going to come home to roost eventually. What this means for investors, what you are looking at is a liquidity problem. And that's what it boils down to. And history has shown that whenever there is a big drop in liquidity, there is almost always correspondingly volatility. Downside volatility, to be specific. The only thing that can prevent more stock market weakness in the Fed pausing rate hikes and returning to its easy money habits of old. We'll find out when the Federal Reserve's Federal Open Market Committee announces its rate decision tomorrow, 2:30 p.m. Eastern Time. I'm going to move on to my report number 2. It's got a picture. Yes, it does. Jerome Powell on the first page. He looks worn out, let me tell you. He's got every idea of having it and deserving it. Fed likely to follow ECB's playbook and hike interest rates this week. The European Central Bank raised its benchmark interest rate by 50 basis points on Thursday. Will the U.S. Federal Reserve follow suit? The answer is yes, albeit a smaller sized move, economists said Thursday. An ECB rate like is a model that the Fed can use, and Vincent Reinhardt, chief economist at Dreyfus and Mellon. The ECB move was an action driven by their macroeconomic responsibility, and it was couched in concern for how things might unfold. They said carefully monitoring a lot. I think that's what the Fed will do. And you probably should, as it will. The ECB move was an action driven by macroeconomic responsibility, and it was coached in concern for how things might unfold, they said, carefully monitoring a lot. I think that's what the Fed will do. The Fed meeting will start later Tuesday and will release its decision at 2 p.m. Fed Chair Jerome Powell will follow with a press conference a half hour later. Fears of financial sector contagion from the collapse of Silicon Valley Bank have eased in the past 24 hours. Late Thursday, a group of leading banks agreed to deposit $30 billion in First Republic, the San Francisco-based regional bank that has been under the microscope since last week's collapse at Silicon Valley Bank. Treasury Secretary Janet Yellen and Powell will become the move, with Yellen stressing the U.S. banking system was sound. And that word sound is be defined in about 62 different ways. So because it says it's down, it doesn't mean that it's over with and that the problem has been taken care of. But they can contain that it is about the liquidity is where liquidity is. Treasury Secretary earlier battled Swiss banking agent, press Swiss, and would get financial help from the Swiss central bank. Powell and his colleagues only need to raise rates by a quarter percentage point because they are started ahead of the ECB colleagues in Frankfurt, economists explained Thursday. A larger half percentage move was seen as too large given the uncertain environment. Pausing would send a negative signal that the Fed was worried about the financial sector. Neil Dutta, head of macroeconomic research, Renaissance Macro Research, agreed that the ECB showed the Fed that the coast was clear for continued hikes. If the ECB could get away with 50, which is a 50 basis points, I think the Fed can go 25. That's a quarter of a point, 25 basis points. Before the collapse of the Silicon Valley Bank, the Fed was said to be leaning toward a 50 basis point move. Powell had left the door wide open for a larger move after 2 days of testimony to Congress earlier this month. The most recent economic data would justify that the larger move. Overly revised GDP, core retail sales, jobless claims, and housing are all pretty strong. We went into the shock pretty good, strong. Instead of signaling that the ongoing rate hikes would occur, said the Fed, would signal the further rate hikes would likely be appropriate. But the central bank was monitoring financial conditions closely. Gradualism works. They can say they are doing more 25s, but no one will believe Powell. Powell won't feel the need to convince markets about how hikes because if markets snap back to where the Fed's, that would be significant tightening, he said. Not everyone agrees that a hike next week is in the offering. Financial contagion, like the smell of perfume, has a tendency to linger, he said, and reappear suddenly. Florida Governor Daniel Tarullo said the shock to the banking system this week will already produce a significant tightening of financial conditions. In some sense, and that was happening to be equivalent of a federal funds increase that could be just to justify a pause at the March meeting, he said. Trading has been volatile all week, and at the moment, traders in the Fed funds futures and market see more than 80% chance the Fed will raise in benchmark rate by a quarter of a percentage point to a range of 4.75 and 5. Rate cuts will follow swiftly, according to traders, but they now expect fewer cuts by year's end than they did earlier this week. The Fed will release its path of interest rates next week. Well, let's see here. Someone needs to tell Jerome Powell that this is not a kill at all costs mission. Cut interest rates now to prevent a full-blown banking crisis. That's an opinion, and it has me on its side of the bench. I would do the same thing because I've seen it happen before. I was looking at an item here. The end of the everything bubble has finally hit the banking system. Credit Suisse and SVB might be just the first of many shocks. The Fed and other central banks face a difficult choice: keep rates high to control inflation, or lose monetary policy to stabilize financial markets. So which one would you like to go by? Which one do you want to do? Which one do you not want to do? And they're debating it. And it's difficult for what they're doing because the outcomes are going to be not well. Major financial market regime changes typically take place in stages. Crypto meltdown in 2022, for example, incurred about 2 trillion of losses. The technology meltdown followed with losses of about 5 trillion. The UK government bond, the gilt crisis, 500 billion in losses, plus an ongoing urging market debt crisis. These problems have now reached the most world's financial system, with US, European, and Japanese banks losing around 460 billion in the market value thus far in March alone. You hear that? March alone. The intermediate cause is the rapid increase in official interest rates in the US and other major global economies. The true cause is the unwinding of economic and financial structure built upon an artificially low cost of money, which gave rise to the everything bubble and its leveraged speculation. That's a fact, Jack. High rates and losses on securities have significantly weakened the global banking system. Banking system's problems may not be over. The collapse of Silicon Valley Bank highlighted the interest rate risk of purchasing long-term securities, financing with short-term deposits, and the susceptibility to a liquidity run. Banks globally face falling customer deposits, projected to decline in the US by up to 6%, and losses on holding of securities, unrealized losses of FDIC insured US banks deposits, and losses on holding of securities. Deposits exceed 600 billion at the end of 2022. A 10% loss on bank bond holdings would, if it realized, decrease bank shareholder capital by around 25%. Now, it's these guys, these people that are writing these reports, and in terms of how they're approaching it, and they're saying that it's probably going to be the worst ahead of us. And I think that's it's a red flag already, more than one red flag. There are several other areas of concern. First, over recent years, investment has flowed into venture capital and early late stage startups. The driver was that abundant capital was itself a strategy. Many unprofitable startups require a near continuous investment. Problems that new inflows into private equity have declined by around 2/3 from the 21 level of around 600 billion as a result of large losses. While some of these companies have sufficient funds to continue operations, many will be forced to close. Second, since the global financial crisis in 2008, regulatory restrictions on traditional banks have shifted. Higher risk or more complex lending or trading into the shadow banking system. Non-bank financial institutions, including insurance companies, pension funds, mutual funds, hedge funds, family offices, and specialty financiers, The Bank of International Settlements estimates that 227 trillion was held in these accounts in 2021, almost half the size of the global financial sector, and an increase from 42% in 2008. The trouble is that information about regulation of these entities is limited. On September 22nd, crisis in UK government bonds triggered by liability-driven investing strategies of the British defined benefit pension plan highlights the potential risk here. Rapidly growing private markets, part of the showing banking list, invest in unlisted equity and debt, infrastructure, and real estate assets. There now is a significant gap between private investment values and equivalent public equivalents, termed volatility laundering, and is achieved by generous assumptions, internal sales of funding, raising concern about conflicts of interest, and reliance on opaque models. Unpleasant revaluation shocks are not impossible. Mortgage-backed securities, as well as commercial real estate and auto loan securitizations, will be affected by declines in asset values and defaults. And that's another fact, Jack. That's only on the horizon. It's waiting. Third, structured products represent another area of risk. Collateralized loan obligations, CLOs, for example, are exposed to defaulting on download rated debt used in private equity, non-agency mortgage-backed securities, as well as commercial real estate and auto loan and securitizations will be affected by declines in asset values and defaults, while higher rate securitization tranches may not suffer cash losses. Downgrades in market-to-market losses are likely. Where used as collateral for borrowing margin calls, many require sales which would realize losses. And I must say, at this point, I'm blinking my eyes. My eyes are dry because of these reports. Most of these reports are a font that's probably, like 2 or 3. I type on my laptop with 11, and I can hardly read it because it printed it just like it was read or printed. Investors own large volumes of black hybrid capital securities, which regulators can force to be written down or converted into equity at their opinion. See, things like this that we don't know what's going to happen to Joe Schmo on the street, but they're going to feel the effects of that. It won't necessarily come to them directly, but it will overhang for a long time. That's my opinion. Investors own large volumes of bank hybrid capital securities, which regulators can force to be written down or converted into equity, their option. UBS's takeover of Credit Suisse Group CS 3.3% triggered losses of 17 billion on these types of bonds credited or issued by Credit Suisse. SVB's failure proves U.S. needs tighter banking regulations so that all customers' money is safe. Finally, derivatives may prove another familiar score and source of instability. These instruments provide exposure to prices and leverage via the ubiquitous carry trade. High volatility across equity, currencies, and interest rates will create higher margin requirements, triggering cash needs. The risk of exciting trading losses and disorderly and uncontrolled liquidation cannot be discounted. Financial weakness will inevitably feed back into the real economy. Defaults, lack of investment, and slowdown in the supply of credit, and led to economic slowdown, which will drive new legs of this financial market reset. The financial market is going to reset itself. That's going to be interesting. All of which this leaves Federal Reserve and other central banks trapped between the need to keep rates high, to control inflation, and the pressure to loosen monetary policy to prevent financial instability. Well, that wasn't a pretty note. I guess I'm wanting to allow you to hear what this is going to be in front of us. And in the process of that, it's not going to be like this past week where they closed a couple of banks and stuff like that. That's just not enough. There's going to be a very large dark side of insuring all bank deposits. And these are the zombie banks. Zombie banks were a name coming from the 80s. Struggling banks kept alive by government guarantees can cause havoc. That's just one of their things that they have. I guess you could call it one of the arrows in their. In light of concerns over more bank runs like the one on Silicon Valley, commentators and government officials are discussing expanding the current 250,000 cap on deposit insurance or even insuring all bank deposits. Ooh. Unlimited deposit insurance, a radical idea that it's gaining steam in Congress. But the proposal to insure all deposits strikes fear in the hearts of some bank experts for a simple reason. In the past, blanket insurance has led to the emergence of zombie banks. When other countries like Japan tried insuring all bank deposits, it didn't really help weak banks attract more deposits. They forced the weak banks to double down on risky investments to make money. They basically do a lot of bad lending. An economic professor of New York University Stern Business was speaking at a discussion about the aftermath of the collapse of the Silicon Valley back at the school on Tuesday night. That's the worst kind of bank you can have in the system. You have spectacular bank failures. The poster child for zombie banks, he said, is the Bank of Cyprus, with bet all of its capital on Greek debt. Even when Greece was actually blowing up, the collapse of the bank led to a bailout of Cyprus itself by international creditors, including the European Central Bank in 2013. To mitigate this risk, regulators have to focus on restoring bank capital and not just focus on depositors. Yes, that's true. That's a fact check. Another. Well, Got two here I'm going to save for the future. And this is all, I guess, going to be a nightmare at some point. It's not going to be a little thing here that it has minor adjustments on these three banks. This was the catalyst of what I had been predicting in the economy this summer. And the reason for that is because it's going to have to affect everybody in the economy. And I wish it wasn't true, but you're going to have to get rid of it in the best way that you can. So forgive me for passing on this hard charging information. I want to thank you, listeners, to stay with it and understand what's going on and what about it's going to be worse. And thank you, listeners, tuning in to Searching for Integrity. So long and happy trails to all until we see and see again. Thank you.